It seems the greater the complexity of a subject, the more we value simplifications, simple principles, simple categories, simple strategies, simple tools, simple choices. This is certainly true in investing. There are literally hundreds of thousands of individual stocks, bonds, commodity contracts, options contracts, and commercial real estate properties to choose from. And there are scores of thousands more of choices in the ways these are bundled into investable mutual funds, exchange-traded funds, closed-end funds, private equity and debt funds, hedge funds, and on and on. So how does one take this universe of complex choices and distill it into a simpler framework for thinking about it all? Well, as we've been doing, we'll keep answering that question over the coming months and years of this podcast. But today, we're looking at one powerful and widely used framework that offers two contrasting ways to grow your wealth. These two contrasting ways are known as the growth and value approaches to investing. The growth approach believes you should latch on to companies or other assets that will grow rapidly over the coming years. Common examples being technology, e-commerce, or biotech companies, even if it might seem that you're overpaying if they froze at the level they've reached so far. By contrast, the value approach believes you should invest in companies or other assets that are irrationally underpriced right now relative to their profit-generating ability either now or in the very near future. Recent examples were airlines, hotels, energy companies, and aircraft manufacturers right after their stock prices plunged in March 2020 in response to fears about the impact of the coronavirus on these industries. So in today's episode, we'll begin by further defining the growth and value approaches. Then we'll discuss both the history of how they came about and the history of which has worked better when. In light of the periodic phases of one leading the other, we consider whether it makes more sense to favor growth, favor value, or maintain a balance. And we discuss whether this growth versus value framework, especially in light of how dominant it has become, has turned what was once a useful simplification into an oversimplification we can improve upon. Stay tuned as we discuss all that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Erik Olson and Adrian Nicholson. We're coming to you right after the 4th of July weekend. Happy Independence Day to everybody. Adrian, how was your weekend?
Oh, it was awesome. Happy Independence Day to all you guys too. Hope you had a good time. I pretty much had a jam-packed weekend, so it was always good. On Friday, or actually Saturday, I went to DC, visited my brother. That was a lot of fun. And then after my fiance and I, we saw a spooky movie, but the only thing really spooky about the movie was the AMC theater we went to. But it was nice going to the movies because we haven't been there in over a year and a half. But so it was pretty solid. And then on the actual 4th of July, we just had a cookout with some friends. It was really good to see everybody. I grilled a lot, so that was fun. A big ball of fire came out when I turned on the grill. I kind of had to dodge it, but other than that, no other major incidents. So the fireworks were a lot of fun. So it was just a lot of good memories. So I had a great time.
Sounds great. How are you? So are you used to saying my fiance already?
No, I'm not used to it at all yet, but I'm sure I'll pick up on it in a few months or so. But everyone's excited. All of our families are excited. So it's nothing but good vibes on my end.
Yeah, nice. Congratulations.
Yeah, I know. You slipped that in there so subtly. I was going to say that's not going to survive this podcast without being addressed. So congratulations.
Thanks,
that's awesome. How'd it go?
I appreciate it. I proposed. All of our families were there. We went. She said yes, obviously, or else I probably wouldn't be on this podcast right now. I'd probably take some time off just to clear my head. But no, everything went well. All the families were happy, and we're just looking forward to the future now, and a future wedding, a future home, a future puppy. It's just a lot going on right now. New office. We're in a new office right now, Roshan. I know you're excited about that.
Yeah.
That's where you're set up right now.
Yeah. I was thinking, you said, if she said no, you wouldn't be on this podcast. You definitely wouldn't be saying my fiance or memories of the weekend. You'd have been saying I'm moving out this weekend.
Exactly. Just gonna take a trip across the country or something.
Yeah. No, that's great.
What I also think is so instructive about your story, Adrian, is that talk about a planner. I mean, you're in the right business, because look how deliberately you approached it. This wasn't just some sort of random impulse. You had all the families there.
They came down from Maine, and they don't really get to experience that many moments because we're all in Virginia. It's like a 12-hour drive. So I just wanted to do something where everyone could kind of have a memory to share all together. So that went great, and all of our friends are excited. It's just everything's going good right now. I'm really happy, and with last 4th of July weekend, just kind of seeing everybody, it was a really great time. I really enjoyed it. I hope you guys had a great weekend as well too.
Yeah, absolutely. So I have my eldest daughter and her husband and our 2 grandkids came out from Seattle. And so we're still getting to hang out with those little kiddos, 5 and 3. It's a ton of fun, but Roshan, I got to say, I think I have much more empathy for you now than I probably have had in a while, just because of the energy drain of just keeping up with their levels of activity. It's amazing. Splash pads, beach. You get there, the minute you get there, you think this is going to be awesome. That's pretty much time to leave because it's not working for somebody. So anyway, we've got to, as grandparents, figure it out.
I learned that with my first, when I love going to the beach. And to me, the beach was sort of laying out and going in the water when you want, just relaxing. And then the first time I took my son, who's now 9, I realized that it's all work when you go with kids. Right. So we're actually going in August to the beach, and we've got both sets of grandparents coming as reinforcements. So hopefully we'll be relaxing to a certain degree, but I'm the best swimmer of the family. So when anyone wants to actually go into the ocean, it's going to be on me.
Fantastic. Well, we got a good topic today. So we're talking, listeners, we're talking about growth versus value investing. And we have a lot to say about this subject, but I think it's worth reflecting for a moment. Why is this topic even important? Because I think that at the very highest level, I will use the understanding the distinction between growth investing and value investing, which we're going to define in just a moment, and then talk about the history and so forth. Understanding this difference is just one step into the larger journey of having a robust idea, or at least a framework for thinking about how investment, what investment options do you have, and how do you actually diversify a portfolio? How do you structure a portfolio in a way that in the long run will be the most productive for you? And furthermore, I think it's also useful if you have this framework, then sometimes you can be more patient with some parts of your portfolio, not necessarily being the top performer. Everything can't be the top performer at any given time. So when something's not the top performer, then you have a way of understanding what might explain that underperformance. And then rather than just saying, oh, terrible investment or terrible manager or terrible this or terrible that, you can instead say, okay, it's just something that right now is somewhat out of phase, and we'll just stay invested and wait for that opportunity to come back. So I think by understanding this, you're able to be a more patient investor, and as a result, have a better outcome, not essentially defeating yourself with shifts that are more reactive than intentional in your investing approach.
Well, I also think this helps you be a more patient investor, because in down times, or when one style is up, the other either may not be up as high, like you just said, or when one's down, one style may not be down as far. So the fact that you're not looking at as deep a decline, I think can help you be a more patient investor as well. So with growth and value investing, these are styles of investing, and having different styles of investing in your portfolio is just an added level of diversification. So I think that's very
Great.
important.
So, yeah. Well, so with this topic, then, fellows, let's why don't we start off with talking about some definitions?
Yeah, that's awesome.
Yep,
That's a good
definitely.
start, Eric, and I can kind of take the lead on that. And again, value and growth, there are some similarities and there are some differences, but these are two things you can probably see people kind of like. Let's just put an example. If you maybe just go out and there's someone that's saying, "Oh, I'm really big into like value stocks," and then there's someone on the other hand that say, "Oh, I'm really big into growth stocks," and they're both given their 2 cents why one's better than the other, and to kind of dive deep and see what they're about is it's just a really important starting place. So growth stocks are typically companies that investors look for future potential return, companies that potentially could beat the overall market, that appreciate really quickly or are just a really strong future potential returns. And value are more stable companies, more slow and steady. They are more mature. They maybe have a lot of historical data to back up the price, but sometimes their price doesn't really reflect what they're actually trading at. And I think we're going to get a little bit more into the pros and cons and all the data that back them up. I think will be really important.
Yeah, and just to go a little bit further in the definition, with growth stocks, you're typically looking for companies whose earnings growth are expected to be higher. A good example of this, I think one of the classic examples at this point has been Amazon. They're constantly a growth stock. If you look back in their history, you're never really able to find them at a point where they were considered cheap on a price to earnings basis. That's definitely a classic characteristic of a growth stock is you're looking at a really high price to earnings ratio. Value stocks tend to be companies that look like they're undervalued, and in many cases they've fallen out of favor for some reason. So thinking of some specific examples, well, one thing that's interesting to note actually is that what was a growth stock could become a value stock, and theoretically vice versa, but typically it goes that way where this was a growth stock, now it's a value stock. I think a good example right now of a value stock might be Ford Motor Company. They are trading at a low PE ratio. They have gone down in value. And I used the term earlier, sometimes the stocks are out of favor. Well, right now in the automotive industry, electric vehicles are more popular. And those stocks are, well, when I say more popular, I mean those stocks are more popular and seem to be more in favor. So the old school car companies like a Ford tends to be undervalued. And as we've always got to give you, because we are all licensed here, these are not recommendations for any stocks. These are simply examples.
Yeah. And there's also like three characteristics that I think are really big for growth and value stocks that kind of really draw that distinction. The three characteristics is the growth of a company, the valuation of the company, and the volatility of the company. For example, let's take a growth stock. The growth of the company is, let's just say it's like a new up and coming company that's looking to eat up like a lot of market share. So that is something that investors will kind of be looking at and pricing and saying, hey, look at this growth company. It's in a new innovative space. It has a lot of great potential. Or let's take a value company on the other hand, where they're a very mature company. They've been around for a long time. They've kind of eaten up a lot of their market share, which kind of helps them get a lot of revenue and profits that are consistent. So that's a big thing that investors look at as well. The valuation, on the other hand, you look at different indicators. One that we could probably go into a little bit that draws a big distinction between growth and value company are the PE ratios, where value companies tend to have a low PE ratio, which means you could probably get at a pretty good price, whereas growth companies sometimes have a relatively high PE ratio or maybe no PE ratio at all, which means they don't really have any earnings. And then the last characteristic, volatility. Sometimes these growth companies can be very volatile. They can have a year where they're returning 40%, and then the next year they could be down 50%. These big swings happen. This is when, the investor needs to consider their time horizon, their liquidity needs. And on the other hand, value, maybe not so much volatile. Maybe it's just a steady company that's like inching up higher, maybe 8% and then 9% the next year, maybe down a little bit, but it's not as volatile as the growth companies can be. So those three characteristics sometimes can be the big things that differentiate these value and growth companies.
So what I'd like to add to what you just have both said is to try to simplify in people's mind or give people a picture of how to think about this. So the word I want to start with is the word value for just a moment, and acknowledge that when we use that term, we can mean different things. So one measure of value can be, what does something cost? But what we're really trying to say is the making the distinction between what something costs, in other words, its price, and what we would think of as its intrinsic value. It's real value from the vantage point of how much return it can generate over some
Erik, I want to interrupt you for a second.
Mm-hmm.
I know you're heading down this line with what you're saying, but I think we should make it clear: price is not value, right? It's not
correct. I agree
just
with
to
that.
clear it up. I know that's where you're heading, but at the beginning you had said price is what you pay, value is what you get. You can get for $100 stock price, you can buy a value stock or a growth stock, and you paid the same price. So I think it's very important to realize that we are not discussing price when we're saying value. And when we're saying valuation, we're saying what you just said, Erik, intrinsic value of a company, what we think a company is worth.
Right. So the way to think about, or if I have a growth investment mindset, my viewpoint about the intrinsic value of a company isn't necessarily merely what its intrinsic value is today. Rather, I'm trying to think out into the future, and based on what I have, maybe is its historical growth rate. And Roshan mentioned one category of that, I believe, which was revenue, or you could also add free cash flows or sales. But in whatever measure you're using, a sort of a fundamental accounting measure, it's not just what you think is there today. It's what you're thinking about, what you're projecting into the future will be true about that. And so you might be saying, I know I am paying a high price for the intrinsic value of this company if it froze today. But I don't think it's frozen. Instead, I think it's going to continue to grow. And if I compare it to all the future cash flows that I, as the owner, would receive if I bought this stock, then it seems to me that the price I'm paying is absolutely worth the value that I would be receiving in the long run. By contrast, a value investor is often thinking more along the following lines. While they may have an expectation about the future, what they're oftentimes thinking is, oh my goodness, the price is so much below what the intrinsic value of this company is right now and in the near future. All I really need to do is not bank on necessarily growth of revenues, growth of cash flows, growth of profitability. All I need to bank on is that the other irrational people that allow this stock's price to get so wickedly low compared to its actual value pretty much right now, or with a few simple fixes in a year or two, I'm going to profit from this investment by just assuming that the price, that other people will get their senses, come back to their senses, and the price of this thing will return to nearer or in line with its near-term intrinsic value.
Yeah, it's kind
Fellas,
of a
any
little bit of
comments
a
about
parallel
that?
for like a discount and a premium where you're looking at this, let's just say the balance sheet of this company, and it looks really strong. They have a good management team. It's obviously not being spoken of all over like social media and the media where it's going to grow, it's going to change the world in the future, but it's got strong fundamentals, and you're looking at it and you can get at a pretty good price at like a discount price, and over time it can pay you for that. And on the other hand, for growth companies, maybe you pay a little bit more for a premium for those like future growing, if they have a new product or service that's really got people amped up and there's a lot of investor demand, you're kind of paying that premium for that potential, that growth, that kind of explosion in price. So it's kind of this like premium discount when you're looking at, are you willing to pay a little bit more for kind of the potential future returns? Or on the other hand, are you willing to, get this strong value, strong balance sheet company and taking out like a discount? But there's also that thing where you have to, if you're loading up on all these like value companies and you think you're getting them at a good price, but over time they're not really performing, then that's kind of that trade-off. Where now I'm seeing a lot of people talking about a blend between value and growth to kind of weather all kind of market environments.
Yeah, and Eric, the way you had described this in terms of irrational investors and getting back to their senses, I'm going to give our listeners a little bit of homework here. But there's a really good example to this, which is Warren Buffett's investment in American Express in 1962. It's the salad oil scandal. Essentially, there was someone who was saying they had all the salad oil. They were trading futures on it. And then when it came time for delivery, you found out that there were actually salt water in the barrels. And so that caused American Express's stock to go down. Warren Buffett famously got in and bought it. And the company was a good company at the time. It was one issue. The decline in their value was not in line with what their losses were. So it's sort of, in retrospect, it just made easy sense. And your description of investors becoming rational and getting back to their senses, I think fits that story really, really well. So that's just a great description. One of the best examples of value investing and sort of irrational pessimism on a company that a value investor could take over. Adrian, you had mentioned earlier volatility and how growth stocks can have volatility. Well, oftentimes volatility, if you talk to value investors, they'll say that's not a good measure of risk and investment. Risk is truly, are you going to lose money or not? Right? So if you buy something after it's crashed and after it's had this huge, multiple extreme movement from a standard deviation perspective in volatility down, well, you're capturing it after the decline. So the volatility is your friend in this case. So just a couple interesting points in perspective. One, look up that salad oil scandal. And two, if you look at a stock's volatility numbers, whether it's a growth and value stock, dig a little bit deeper, because that volatility can be your friend or your enemy if you're on the wrong. If you bought it before the drop, volatility can be your enemy. So look at that volatility a little bit deeper than just the number of what is the volatility of the stock.
Since we're telling stories, I'll say our listeners can think back to just 15 months ago or so, when prices on a lot of things plunged in the wake of the recognition that the COVID-19 virus, or the coronavirus and the COVID-19 disease, was turning into something really big and was going to have an impact on a lot of sectors of the economy. Airline stocks, hotel stocks, airplane manufacturers, cruise lines, energy companies. A lot of these companies took a massive, massive dive at companies that were in some cases trading at prices that they had not traded at since the late 1990s. And you had to ask, well, in some cases, perhaps the emperor has been found to have no clothes, and this decline in price is actually the revealing of what actually should probably be the price. In most cases, I would say, hindsight, of course, has helped us assess this, is that, you know what, hotels aren't valueless, cruise lines aren't valueless, airlines aren't valueless, Boeing as an airplane manufacturer is not valueless, and what you've seen is that the bold who were willing to step in at some of those price levels and buy have done pretty well since that point in time. So let's talk a little bit about the history of value investing, because I think that brings some more life to what's going on here. I have a few comments, but is there something you'd like to start with?
But most of the stuff I found about just kind of the history of value and growth, just value like multiple decades ago has just been like one of the best performers until like the more recent decade where kind of growth took over. Is that kind of a gross summation, Eric, or does that kind of fall in line with what you've been finding?
Well, actually, I would say that you've highlighted one part of the history, which is how in the contest between value investing approaches and growth investing approaches, when has one or the other prevailed? And in the long run, should you pick one and just stick with it, or pick the other? That's one part of the history. I think the other part of the history is just the intellectual history. Where do these ideas come from? And so I'm sure that we could certainly expand our own knowledge of the history, but at least within our framework here as U.S.-based investors, one of the leading examples is the person who essentially Warren Buffett drew his initial lessons from, which is his mentor, Benjamin Graham. So Benjamin Graham had a method of investing that he characterized as cigarette butt investing. Have you guys heard this term before? Yeah.
Well,
so his attitude was
cigar butt investing.
So I said, I said cigarette, cigar butt investing.
No
Thank you. So if you're walking along a sidewalk and you see a cigar butt sitting on the sidewalk, now most of us would probably not be super excited to own that cigar butt. But in light of the fact that it's free and we could pick it up and extract a few more puffs out of that cigar butt, its price, in this case free, relative to its value, a few remaining puffs, is an example of buying at something lower than its intrinsic value.
That is a pre-COVID example.
A pre-COVID example. Right. Good. Highlight that. Kids don't try this at home. But but that idea took root and actually was what influenced initially, since we're talking about, I've mentioned Warren Buffett, influenced his thinking as well. And in his early going, he was really looking for these deeply undervalued companies, among which a term came into, or at least a method, which was to look and let's look at their price compared to even just the cash that they have on hand. If we can buy them for less than their cash on hand divided by the number of shares outstanding, then without question, this represents buying at less than the intrinsic value, because even if the rest of the business is worthless, just the cash, and if we then give some allowance for value in the business itself, we've now just added to the value that we've obtained at this relatively low price. So these concepts began to be formalized then in a much sharper way, starting, I would say, in an industry moving way, starting in 1987, when Russell Investments created two indices, the Russell Value Index and the Russell Growth Index. And that was reinforced in...
Can I interrupt you just to add a few things? Now, I am a fan of Buffett and Benjamin Graham. And so I just want to add a few things before we move on that I think are very important. So first, Benjamin Graham literally wrote the book on investing. It's called Securities Analysis, whether you're a growth or value investor. That's a book you have and you read. It's a textbook. The Columbia Business School of Value Investing is still called the Graham and Dodd School of Value Investing, where he taught. He wrote another book called The Intelligent Investor, and that book spends a lot of time talking about the mindset of the investor. As an investor, you're a partner in the business. markets open and close every day and stock prices change every day. And Graham would call that the voting machine. The market's the voting machine. People are voting whether the price should go up and down today. Businesses don't change every day. And if you approach it as buying a business, you look at all the votes that have been cast on a company. You look at the value of the company. The value of the company, he would say, is the weighing machine. If the votes are saying the price is worth less than the weight, so to speak, of the company, that's when he would look to invest. And he would invest using what his term called the margin of safety. There's a great book by Seth Klarman called The Margin of Safety. Klarman is a very famous value investor, not as famous as Buffett, but he's done phenomenally well, great performance. And his book, Margin of Safety, if you try to get the book, it literally cost thousands of dollars. It went to print once. He never let it go to print again. I was lucky enough to find it at the DC Public Library about 15 years ago. I returned it, tried to check it out again, and as has happened many times with that book, it got stolen and was probably sold online. It was never came back to that DC Public Library. But coming back to my point, there are a couple important things I think you need to know. One is approach investing as a business owner. You are buying a part of this business, you're going to own it. The second thing I think is very important is this concept of margin of safety. Buying a stock, buying a company, because remember, you value the whole company at a price significantly lower than its value, gives you a margin of safety so that if somehow your analysis is wrong or if something goes wrong, you still have the odds in your favor from being profitable. He would always say that your profit or loss is determined at the point of purchase. And the other point I think is really important about this and how revolutionary this was at the time. He was doing this at a time of where being a speculator was a profession. You know, people would literally speculate and trade stocks. So his concept was very powerful and very. It was brand new at the time, and he was teaching this concept. The last thing I'll mention is, and I won't get the story exactly right, but Warren Buffett asked Graham. Warren Buffett was his student at Columbia, asked him if he could work for him for free, and Graham's response initially was something to the effect of, well, you have significantly overvalued yourself or your worth, or something like that at the time, and said no. So at the time, he thought free was too much to pay for Warren Buffett to work for him. Now, later, he brought him on, but at the time, he said that. So, Erik, I'm going to send it back to you. As our listeners have heard me say in the past, and I'll say it again, I'm a huge fan of value investing in some of these investors. So I just wanted to add a little bit there.
Okay. Well, we should have someone who is a giant fan of growth investing come in and give sort of glowing reports of the history of that as well. But I love that, what you just said, because I think that those stories tell well. So coming back to the value versus growth framework of thinking, as opposed to just the value side, which has a deeper, I think, formalization of its intellectual antecedents, or at least underpinnings. When Russell Investments in 1987 created these two indices, they started to take hold. And that was reinforced when in 1992, Morningstar created what was known as its equity style box, which then also shaped people's thinking about, okay, there's value, there's growth, and then there's blend as styles of investing, along with large, medium, and small companies. And so you could develop this somewhat more granular approach to looking at parts of the market and styles and size combinations within the market that would guide your thinking there too. And then also in 1992, two really influential researchers, Eugene Fama and Kenneth French, began publishing their academic research on what they called the value premium. That is, buying things. In their case, they were looking at one measure, which was the price of something compared to the book value, or the price of a company's stock compared to the book value of that company's stock per share. And their work said, let's compare the outcomes from investing in companies where the price relative to the book value is quite low at the point of purchase versus those where the price relative to the book value is quite high. And let's see how they subsequently perform. That further reinforced this notion of the utility of making this distinction between growth and value, and weight in many people's minds, therefore weight or overweight the value side. The critics of this distinction, though, are growing, and I'll talk about that in just a moment. But are there any aspects of this history, fellas, that you want to, at least on the intellectual side, deepen, or should we also then just talk about some of the actual performance
history? Is this
history
theme
here
kind of similar to like the Nifty 50, where people, like investors, would look at invest in like these same companies because they're doing well, their price is going up, and the Nifty 50 were like these 50 companies, I think, that just, the price was just going up, and investors just kept investing in the same companies over time, making a career off of it. And then over time, people were looking at these other stocks, kind of people ignored that. They looked at their value, looked at their balance sheets, looked at the management, saying, hey, these stocks, their prices are very low compared to these same ones that have just been going up and up. There's more, let's just say, value here to take, and then they kind of shift over there. Is that kind of like a similar theme in this concept, or is it something different?
Well, I'm going to, for great question, I'm going to say Roshan may answer it differently, but my view about this is those are a little bit different, because I would think of the value versus growth conversation as a framework for thinking about how to approach investing, whereas I would say the Nifty 50 concept is a demonstration of how a lot of public enthusiasm for a certain set of companies can take hold, and people become enamored with those companies, thinking that they're indefinitely going to be fruitful investments for their portfolios, only to find out later that the stocks and companies have their own cycles, and clinging to those Nifty 50 because they were successful during a certain phase in the 60s and 70s doesn't necessarily mean that they're going to be indefinitely successful into the 80s, 90s, the aughts, the teens, and so forth, and into the 21st century.
Yeah, and the Nifty 50, the way that went also, it definitely, I think, would be a growth story, right, in terms of people adding to this. So I would agree as it being a subcategory. The only thing I would add of growth, yes, investing. Correct. Thank you, Eric. The only thing I would add, though, to what you had said that I found interesting while preparing for this is, we're in the DC metro area. Baltimore's right around the corner. I didn't realize that T. Rowe Price was considered the godfather of growth investing prior to this. I'm familiar with the firm. I'm familiar with their funds. I know they've got growth funds there, but I didn't realize that as Graham is considered the father of value investing, T. Rowe Price has the same is viewed the same way in the growth space. There are others like Phil Fisher, also in that space. But that was new information for me that's what the foundation of the firm in Baltimore. That they've still got their high-rise building there that I see when I drive by. Yeah.
Well, so. I had no idea. I did not know that. Of course, they have a legendary fund that's focused on capital appreciation as well, and it's been quite successful. So now when you say that, it doesn't surprise me.
It makes sense, right? When you hear it, same thing, kind of clicks.
Mm-hmm. So I guess, but I think it's also, as we talk about the history, important for our listeners to understand is that when we talk about these two styles, there can be prolonged divergences in the outperformance and hence, or reciprocally, the underperformance of one style versus the other. Guys, did you track any sort of long phases, kind of the phasing in and phasing out, or the switching of these between these two to track their performances?
Yeah, I definitely have.
If not, I have.
Go ahead, Eric.
Yeah, if not, I have something I can share that I think outlines this a little bit. Please go ahead. Okay, so let's just go back, I think probably 40, 50 years. And if we start, let's say, with the mid 70s. This is just before the right on the heels actually of the Nifty 50, since you mentioned that. When markets unwound in 74 and 75, there was a period of time there where, I'd say probably for 2 or 3 years, value was crushing growth. And with a few exceptions, that outperformance of value was sustained for a really long time. I would say that solidly up until probably the next 20 years, with a few exceptions. Into, let's say, 1994, that was true. Starting in 1994, you might remember the markets just took off, and this was in the wake of the House of Representatives for the first time, shifting from 40 years, I think it was 40 plus years of Democratic control to Republican control. And so I think investors thought, generally speaking, that might lead to a more favorable regulatory framework, a more favorable tax environment, and so forth. And as a result, that it gave the sense, at least among many investors, it's off to the races. And indeed it was, until the markets peaked. At the peak of the internet bubble, it was growth. But when the internet bubble burst, or the technology bubble burst in early 2000, then as you had that massive market decline, particularly in those high-flying technology stocks, value stocks held up really, really well, and their outperformance ranged for a period of time there on a trailing one-year basis, 10 and 20% ahead of where growth stocks had been. And that outperformance of value persisted again until about 2006, 2007. Starting at that point in time, 2006 or 2007, running until middle of 2020, it was again almost all a growth story. Yeah. So that's a long time for growth to defeat value in a really powerful way. And a lot of the value investors, the legendary value investors, got driven out of the markets. They just threw in the towel at the peak of the internet bubble in late 99, 90, 97, 98, 99, and just going, what's going on? This is crazy. Fundamentals just aren't being paid attention to any longer. I don't know how to invest. It seems like the world has completely changed. And indeed, there were people who were arguing that the world has indeed changed. They were saying, all of the conventional ways of measuring a company and assessing its value have completely changed. Well, it's been feeling like that for value investors now for a while, and particularly in the run from 2016 all the way through mid-2020. That has seemed true again for value investors.
Excluding 3 years, we're really talking 2009, right? If you look at it as far as growth outperforming value, you've literally got between 2009 and 2021. So in that 12-year time period, it's won 9 out of 12 years.
Yeah, I would say, I'm going to say even it goes back even deeper to 2006, 2007, but I will acknowledge just at the deepest point of the plunge when the great credit crisis sort of completed itself, then value held up a little better than growth. But, oh man, it has been a tough time for a long time to be a value investor. And then since middle of last year, right after the initial rebound from the bottoming process following the COVID reaction, I think it's been now value has had a pretty solid resurgence. Nothing to erase years and years and years of outperformance of growth, but you're seeing now something of a turning, and value investors are wondering, is this momentary or is this something that's prolonged? Comments about that?
Well, I tell me a little bit about the numbers you're seeing, because if you look back a year, I'm still seeing that growth is outperforming value. So now in the fall of last year, value had a little bit of a run, but it was pretty short. And like I'm looking at the data now, and it looks like value is doing better than it has in the past. So it's improved, but it's still losing to growth. Are you seeing something different?
Yeah, I am seeing something different. So maybe what we should do is put put it
Well, what time frame are you looking
rather
at?
than because
we'll move on. I'm just curious, and I'll do
at
the same research. But what time frame are you looking?
So from about May or June up until about May or June of last year until about March or April of this year. So let's
just call it a one year time frame. I'm looking at the indices.
9 months.
Okay,
maybe.
Yeah, I can do. I'm just clicking on what's easy. I can do 6 months and 1 year with the click, and I'm still seeing growth beating value in those time periods. But why don't we keep moving on, and we can argue about this offline and look at some data, because I'm not saying you're wrong. I'm saying I'm seeing something different, and if I'm missing it, I want to know.
Well. And also, I'm not isolating this to only large value. I'm also talking about mid value versus mid growth, small value.
I'm looking at the entire value indices, value versus growth comparison.
Okay, well then we'll resolve that. But anyway, even if we allow that I'm wrong on this one, which is I'm totally fine being wrong on this.
So am I, as long as it's a profitable
move. For years and years,
as long as whatever we do is profitable, I don't care who's right.
For years anyway, from a price standpoint, growth has really been trouncing value. So you might ask, well, then why is this intellectual fascination with this conversation? Why not just be a growth investor if it's so demonstrably the case that growth investing has outperformed? And I think that leads me to want to talk about some of the criticisms of this framework. But I don't want to jump there if there's more that either of you wants to say about the history aspects.
Got nothing to add on history.
Okay, so let me talk about some criticisms of this framework. So you heard me say that in '87, Russell Investments comes up with these indices. Then Morningstar reinforces it further with the style box structure in 1992, and then the research of Fama and French. So if you're not careful, especially on the Fama and French side, and you say, I'm going to compare companies that have a low book to value to those that have a high book to value, and then a low price to book value compared to a high price to book value. And then if you aren't careful, you may assume that that's a statement that value itself outperforms growth. That's not what that research showed. There's research showed that good value outperforms bad value. That's not the same thing as saying value necessarily outperforms growth. Because if you're lazy about it, you may say, well, isn't growth by definition bad value? No, it's not. Growth by definition is growth. And what you pay for that growth is a separate question. So the value investor is concerned with price, first and foremost, relative to the perceived intrinsic value, whereas the growth investor, while certainly sensitive to the question of price, is much more sensitive to what they perceive to be the long-term growth prospects. So I'm going to use a term here that any of you who went to graduate school or in your undergraduate years perhaps hung out around too many social science people, you've heard the term hegemonic, meaning that a framework of thinking starts to dominate everybody else's thinking, and it's so powerful as a concept that it makes it hard for people to think outside that framework. I would say that to a certain extent, the value growth distinction has had that hegemonic effect and made people think a little less clearly about investing. In said differently, one criticism of this approach is that it's creating a false dichotomy. At any given time, it isn't the case that, let's say, the 5,000 or so publicly traded companies of some size level are clearly can clearly be segmented into either growth or value. Or if you allow a little bit more freedom with those definitions and use Morningstar's approach to it, they can be neatly divided into the third that are the value stocks, the third that are the growth stocks, and the third that are in the middle and are what they would call blend stocks. At any given time, you're going to have probably only a few that are radically underpriced, and only in terms of percentage terms, I'm talking about a small percentage that are radically underpriced relative to their value. Some, only a handful in percentage terms, that are radically outperforming all other companies on the pace of their growth. So what about all those other companies that are in the middle? How do we make sense of, or how do we approach the question of incorporating those or excluding those from our portfolio? And I think that's where there's potential to think in different terms than strictly value and growth. Guys, your thoughts about that? Because I'll suggest some ways of thinking about that differently. But before I push into those, what are your thoughts about that?
Well, I mean, I wouldn't argue against what you're saying right now. I'm looking for what do you think some of the uses are, or the alternatives, right? Because what you described with value and growth, I know you weren't talking about efficient market hypothesis, but when you gotten to like hegemonic, that using the term and saying that view, that made me think of that efficient market hypothesis, which had a lot of following at the time and still does now. Right. Which yes, I'm not a fan of personally as well. But
do you want to explain that concept since you brought it up?
To simplify it, the efficient market hypothesis is saying that you should just buy the index because stock prices are always based on all readily available information, and the market is efficient enough so that all stock prices are always accurate. So why bother trying to find things? And this specifically almost targets the school of value investing. I would say a little bit more than growth, just because with value, you're trying to say what a company is worth and find a discrepancy based on what the value of a company is and what the stock price is. And efficient market hypothesis says the value of a company is what the stock price is, because it always has all publicly available information embedded in the stock price. So there's no opportunity for anyone to outperform. The reason it gets a lot of complaints from the value space in general, or really from a lot of investors, once again, my research analysis being in value and my leaning towards that has more information there. But Warren Buffett once said, well, if I'm competing against other investors and you've just convinced everyone to stop thinking, you've helped me out. You know, something to that effect with the efficient market hypothesis. And there are just too many examples of the markets being inefficient, and they tend to overshoot when something bad happens. Erik gave a long list of companies from just a year ago earlier. So I'm not necessarily the biggest fan of that either, but that I'm excited to hear your conclusion of sort of debunking or getting away from even making the classification of growth versus value.
And Roshan, real quick, for the efficient market hypothesis, does that mean also like you shouldn't try and use fundamental or technical analysis? Because that's a big portion or like a big part of like the other hypothesis, where you say you can use technical analysis to come to a price where you can get in, or you can use fundamental analysis to value these companies, determine the good price. Fundamental and technical analysis plays definitely a role when it comes to growth and value. But like you said, the efficient market hypothesis tells us that, you know, you're better off just not worrying about that and just using like an index or whatever it may be.
Yeah, well, they essentially say don't waste your time doing anything. Just buy the index or buy all the stocks that you want, because it's not going to make a difference. So yes, that is definitely in line with what you said about technicals. They would say don't waste your time with it as well.
Well, we've kind of drifted into the efficient market hypothesis and index. So I think what might be useful for us to do is to have a separate conversation about active versus passive investing.
Yeah.
Because in essence, the conversation about the efficient market hypothesis is is really at the core of the active versus passive debate. So here's where I'm just going to insert one little jab. I don't usually like to jab, but I am going to just, as a preview of coming attractions, if we do an episode on that subject, is with very few exceptions, most people who use the language, or at least profess to be adherents of, if the efficient market hypothesis, or said differently, very, very few of even those who profess to believe that passive investing is the way to invest. In reality, if you observe what they do, they are indeed making bets on certain parts of the market, which, while they won't want to acknowledge that that's an active investment decision, it is. The truly passive investor would say, I'm going to look at all the assets in the world, all the assets on the planet, and I'm going to own them in direct proportion to their the ability to own them. So real estate, international, emerging markets, commodities, etc. I'm going to own them in proportion to that. So, but when someone says I'm a passive investor and my portfolio consists of essentially the S&P 500, no. Now you're making a very, very active bet. You say you're a passive investor, but you're making a very active bet that large U.S. stocks are the place to be, and you're excluding from your portfolio all else. And so I could tease that out, but I think it is the like many religions, efficient market hypothesis has many that profess to be believers, but few who actually live in an alignment with their professed beliefs.
We definitely
Need
to come back to this, but let's get back to where you were going. The criticisms of growth versus value, or even categorizing them essentially.
Yeah, so I think that I'll say that it oversimplifies, and it's the magnitude of its place in people's thinking relative to its utility as an investment guide is mismatched. So I would say that other ways of thinking also should be introduced into your investment analysis, and that's what we'll try to do over the coming months and years in this podcast, as is our want, to kind of drift back and forth between investment topics, tax topics, life topics, etc. But let me mention a few. So in the final analysis, I think what you're trying to do is to evaluate or assess an asset that you can own and that you can purchase at a price that you're not overpaying for that asset as an owner over the full arc of your ownership period. So if that's years, then you want that to deliver more value if we're talking about stocks, in the case of free cash flows to you, and have those growing, then you're having to pay for them now relative to other sorts of things. So what are some other measures that you can use? Well, first, in the value category, you can use multiple measures of value. So let's just leaving it right there. Instead of, let's say, price to book, or maybe the more widely used example is price to earnings, the price per share of a stock relative to the earnings per share of that company. The price per share relative to the earnings per share, or price to earnings ratio. What about price to sales? What about price to free cash flow? What about, said differently, what about, instead of using price per se, what about using a combination of, price is a reflection of the underlying market capitalization of that company. What about looking at the price of the cost, or let me restate that, the total value of not just the equity in the company, but also all the debt that company has taken on, and then comparing its cash flows or its sales or its earnings to that combined value of equity plus debt, which in a simple form we call enterprise value, and so forth. So we can use different measures of value to arrive at this. And some of those latter measures lead us into conversations about what we would call, in a large way, quality measures. So looking for quality companies with what we would define as quality cash flows or quality sales, and not just in a static sense, but in a dynamic sense, growing cash flows, growing revenues, growing sales, growing earnings. Those sorts of measures lead us into a different territory. I'll mention one more, and then you may have others to add to this as well. But the concept of the competitive advantages that are now being characterized in the language that's being used for these is the moat idea. So if you have a moat around your business that makes it hard for competitors to come in and undercut you, then you have tremendous pricing power in the marketplace. And as a result, you have the potential then for higher profitability as a company, which is a quality measure, and which, if it's growing, is also a growth measure. So to summarize, I think it is useful to add other concepts into the mix of all of this, and not kind of reduce your analysis to these overly simplified categories of value versus growth.
Yeah, you can definitely go deeper into all of these different areas. I don't think anyone can argue that. The question I'd ask you, though, is when you look at that chart comparing growth versus value and performance, does it make sense to own some of both? I know what this is. I'm thinking about execution versus criticism at this point, but you can definitely go deeper. Fully agree with you. But how do we use the information that we have now? Wouldn't it just make sense to have a little bit of exposure to both?
I would say so, and I would just say those are factors.
Yes.
Or in a larger sense, I would have multiple factors as part of the portfolio. I would not say, well, growth is where it's at, therefore I'm going to eject all value-based investments or value approaches from my portfolio, or vice versa.
Yeah, I would agree with you. Adding factors definitely helps. Another thing that I believe, Erik, either you or Adrian, you may have mentioned this earlier, just the concept of a blend. Like the S&P 500 is considered a blend because it has both growth and value in it. So you can get something like that in your portfolio where you've got a blended investment or blended investment fund. So you've got a little bit of both. It's not an equal split. So if you want to do an equal split, especially in the world of ETFs today, you can easily get a growth or even mutual fund, a growth mutual fund versus a value mutual fund, and then get more of an equal split there versus a blend. But there are easy ways to execute on this concept of having both growth and value in your portfolio. Here, I would add one last thing in closing, but let me actually ask either of you if you've got anything you'd like to add in closing first.
The only thing, I guess I mentioned it before, how the individual investor can look at it. Again, like time horizon is a big thing. If you're a beginning investor, you might be drawn to some of those like growth stocks for that appreciation, or if you're someone close to their retirement, or kind of shifting a little bit, you might look at like value stable companies. Or again, just looking for that blend. I know we talk about diversification across different asset classes, but if you're looking at individual stocks, you can diversify even more here. There's just all these subcategories to really look at, all these indicators to really go over. And there's just, like we always say, like do your research, and it'll go long for you in the future.
Yeah. So what I guess the last thing I just want to say to you, our dear listener, is that we've talked a lot about these and the value of educating yourself. And so there's many, many resources that you can discover. I'm sure if you're listening to this podcast, you know how to locate a podcast. And so undoubtedly, I would imagine you also have some pretty decent research skills. But if you'd like to have a conversation with some advisors that think about these things in the way that we do, you can go to the show notes. You can find our contact information. We'd be delighted to try to engage in a conversation with you and see if there are approaches that you have, or thoughts that you have about all of this that you'd like to have a second opinion about, and love to have that conversation with you and help you in your investment journey. But we thank you so much for listening, and encourage you to share what we're doing here with your friends, and let people know about this. If you haven't subscribed, please subscribe. And if you haven't given us a review and you're enjoying what we're doing, you know what? If you give us a pretty good review, you're just going to make it easier for other people to discover this show and hopefully share in the benefit of the learning that we're trying to provide here as well.
Yeah, I wish I didn't have anything to say because that's a great closeout, but I've got one final thing, and then I'm going to agree with.
Sure.
Once again, Erik, with everything you said, I agree with. Adrian, you mentioned time frame, and I'll often say to people, there's a concept in investing where people will say, what's your edge? It's what do you know that the next guy doesn't know, or what puts you at an advantage as an investor? Oftentimes, I'll say your time frame is your edge. Right. So, Adrian, as you mentioned time frame, I think that's a very important concept. The final thing I wanted to mention, though, was there is a type of investing that sort of falls a little bit in between that Peter Lynch made famous called GARP investing. That stands for growth at a reasonable price. So today we were discussing growth versus value. If you thought you had some interest in both of these, that might be another thing for you to look at, GARP investing. And as I said, Peter Lynch has written multiple books on the topic. Now, I'll just echo what Erik said. Please like, subscribe, give us 5 stars, tell your friends and family about us. And we will be back next week. Thank you for joining us for another episode of the Retirement Lifestyle Show.